Okay, let's just dive right in. It is January 24th, 2026. You open your portfolio app, maybe with one eye closed because, well, let's be honest, it's been a rough ride.
Very rough, and you see Ethereum just stuck.
Exactly. It is just hovering right around that psychological $3,000 mark.
Which feels incredibly heavy right now given everything else that's going on.
Heavy is an understatement. I
Yeah.
mean, we just came out of Q4 2025 where ETH dropped, what, 29%?
Nearly a third of its value.
Yeah.
In one quarter, it was brutal.
So if you're a listener you've been doing your homework, believing in the roadmap, you are just frustrated.
And you have every right to be. The price action has not matched the narrative at all.
But here's the part that is driving me absolutely crazy. I close my portfolio, I open up, my news feed, and the headlines are screaming the exact opposite.
Rather transactions?
Institutional adoption, the tokenization of everything. So I'm sitting there thinking, okay, if usage is at an all-time high, why is my portfolio bleeding? The math just isn't mathing.
It's the definition of cognitive dissonance in crypto.
So that's our mission for this deep dive. We are digging into the Ethereum paradox. We're going to look at what feels like a civil war happening between the mainnet and its layer 2 children, which I think is the real story here.
I think so too.
We're going to find out if that revenue renaissance we were all promised in 2025 is officially dead. And and here is where I really need you to convince me. We are going to break down that controversial $9,000 price prediction for early 2026.
It sounds kind of impossible looking at the chart today, I get it. But when you dig into the data, that prediction, it actually has some serious legs.
We'll see. We've got a massive stack of sources today. Reports from Bitwise, Arkham Intelligence, 21 Shares, plus some really deep legal economic analysis on this glass ceiling theory. So yeah, buckle up.
Let's do it.
Starts off with the pain points. Why did Q4 2025 look so ugly on the charts, but so good on chain?
It's just a massive divergence. I mean, usually in crypto, price and usage are pretty correlated. Usage goes up, price goes up. Yep. But late 2025 just completely broke that model. If you look at the Bitwise report for Q4, the on-chain activity is, it's exploding. Transaction counts are hitting all-time highs. Stablecoin AUM is soaring.
Okay, give me a real number here. How much money are we actually talking about moving through this stuck network?
The annual transfer volume has crossed $50 trillion.
Wait, say that again? 50?
50 trillion, with a T. And to put that in perspective, that's starting to rival major global payment networks like Visa.
Okay, stop right there. If Visa was moving $50 trillion and growing at this rate, their stock would be through the roof. So why is ETH lagging? Why isn't the price reflecting that insane volume?
Because of a prediction that failed.
Yeah.
Miserably. Do you remember the big narrative back in early 2025? The Ethereum revenue renaissance?
Oh, I remember. It was so simple. Usage goes up, fees go up, we burn billions of dollars of ETH, and supply and demand sends the price to the moon. Ultrasound money.
Precisely. And that prediction was just wrong. 21 Shares put out a scorecard recently, and they marked revenue renaissance as a hard wrong.
So what was the actual revenue?
Ethereum Layer 1 revenue actually fell to roughly $286 million year-to-date in 2025.
$286 million on a $50 trillion network. That's peanuts.
It is. It's materially lower than even the post-Denkin levels we saw the year before.
So usage is way up, but revenue is way down. How does that even work? Do we just put the entire network on a discount rack or something?
In a way, yes. And the culprit, or maybe the hero, depending on your perspective, is EIP 4844.
The blobs.
The blobs.
Okay, I feel like we talked about blobs nonstop in 2024, but for the listener who maybe just tuned out the technical jargon, explain it like I'm 5. Why did blobs kill the revenue?
Okay, so think of the Ethereum blockchain like a trucking company. Before 2024, every time a Layer 2 network like Arbitrum wanted to move data down to the main Ethereum highway, it had to stuff it inside the truck's cab with the driver.
That's the old call data.
Right. And space in the cab is super premium. It's limited, it's expensive, and once that data was in the cab, it was stored forever in the company's history.
So we were paying for premium seats and permanent storage for data that, honestly, we probably didn't need forever.
Exactly. So EIP 4844, introduced blobs. And you can think of this like attaching a really cheap detachable trailer to the back of the truck.
Oh, okay.
The L2s load all their data into this trailer. The truck drives it to its destination, proves it arrived, and then, and this is the key, after about 18 days, The trailer is just detached and the data is pruned. It's gone.
So we're not clogging up the archives anymore.
Correct. And because it's temporary, it is incredibly cheap.
Yeah.
We're talking about a cost reduction for layer 2s of anywhere from 10 to even 100 times.
Which is great for me as a user. I mean, my transaction fees on Base or Optimism are basically zero now. I love that part.
It's fantastic for users. But it's terrible for that ultrasound money narrative. Because the fees are so low, we just aren't burning enough ETH to offset the new issuance that gets paid to stakers.
So the network turned slightly inflationary again.
It did. The deflationary thesis that drove so much of the last bull run has essentially been paused.
So we sacrificed the pump for the scale.
That is the trade-off. We chose to make the network usable for the entire world, rather than just profitable for the holders in the short term.
And that leads us directly into this civil war you mentioned, because if the money isn't going to the main network, where is it all going?
This is the really fascinating part. It feels like the children are eating the parent. I mean, cannibalization is the word a lot of analysts are using.
I'm looking at the Dune Analytics data right here, and Layer 2 networks are now handling over 85% of all transactions.
85%. The mainnet is basically a ghost town for regular users. I mean, if you're swapping tokens on mainnet in 2026, you're either a whale or you just haven't updated your wallet settings.
But it's not just about the transaction counts. This is about profit, right? Who is actually winning this game?
The layer 2s are operating as what we call spread businesses.
Like a bank.
It's a very similar model. They charge you, the user, an execution fee. That's their revenue. Then they turn around and pay Ethereum mainnet a tiny fee for that blob space. That's their cost. And because that cost is so low, their margins are just insane.
So who's the biggest winner right now?
Base. Coinbase is layer 2. You cannot look at the 2025 data without talking about Base.
Give me the numbers.
In May of 2025 alone, Base operated at a 98.3% profit margin.
Wait, hold on. 98%? That's better than software margins. That's like illegal levels of profit.
It's incredible. They generated nearly $6 million in revenue in a single month, and they kept almost all of it. And get this, Base actually flipped the Ethereum mainnet in DAX trading volume for the first time in 2025.
Layer 2 doing more volume than Layer 1. That feels historic. But going back to the Civil War idea, isn't Base acting like a parasite here?
That is the debate. It really is.
I mean, think about it. That's $6 million in profit. In the old system, that would have gone to Ethereum stakers. That would have burned ETH. Now it just goes to Coinbase shareholders. They're sucking the life out of the asset I'm trying to hold.
That is the parasite argument. And if you're an ETH maxi, it makes your blood boil. You're providing the security, and someone else is taking the lunch money.
But I kind of lean towards the symbiote argument.
Why? They're clearly taking the money.
Because without these cheap Layer 2s, where would those users have gone?
Solana.
Exactly. They would have just left the ecosystem entirely. Layer 2s, for all their profit-taking, kept those users in the Ethereum orbit. And we're seeing this clear split now in how institutions behave. They settle on Ethereum, it's the ultimate bank vault, but they transact on Layer 2s.
So Ethereum becomes the settlement layer, the boring infrastructure, and the L2s become the shiny app stores where all the action happens.
And all the profit. Okay, so if the profit is all moving to L2s and ETH is becoming this boring utility with no fee burn, why on earth is Tom Lee from Fundstrat predicting ETH to hit $7,000 to $9,000 by early this year?
It seems completely contradictory, doesn't it?
It sounds like pure hopium. Revenue is down, so price goes up? I mean, explain that logic to me.
Well, Tom Lee's track record is pretty hard to ignore. And his thesis isn't about fees. He doesn't care about the gas burn. His entire thesis is about the tokenization of everything.
RWA, real-world assets.
Right. The RWA market on Ethereum surged from just over $8 billion to $25 billion in the first half of 2025 alone. We're talking about treasury bills, private credit, even real estate starting to move on-chain.
But why does that push the price of ETH up if the fees are so low?
Because Wall Street needs a settlement layer that is secure, decentralized, and has 100% uptime. There's only one chain that fits that description perfectly.
Ethereum.
It's becoming the risk-free rate of the digital economy. If you are BlackRock or you're Franklin Templeton, you are not going to put $1 billion of tokenized treasury bills on a chain that halts every few months. You put it on Ethereum.
So the value comes from what analysts call the monetary premium. It's like gold. Gold doesn't pay a dividend. It has no cash flow. But it's valuable because everyone agrees it's the safe place to park wealth.
Precisely. If ETH becomes the primary collateral for the global financial system, the price has to go up, regardless of how much gas you're paying for a swap. The demand comes from the need for collateral, not the need for block space.
And there's a big whale in the water too, right? Bitmine.
Yes, Bitmine immersion technologies. You really have to pay attention to them. Think of them as the MicroStrategy of ETH. They've been aggressively accumulating, holding over 3.5 million ETH.
That creates a kind of institutional buy pressure that just didn't exist in previous cycles.
A persistent one, yeah.
Okay, so the bull case is ignore the fees, look at the collateral demand, but I have to play devil's advocate here. While Ethereum is having this internal identity crisis, am I a tech stock? Am I digital gold? The wolves are at the door. Let's talk about Solana.
They're not dealing with this layer 2 fragmentation at all, are they?
Not at all. They're taking the monolithic approach, integrated, fast, and they are moving very, very fast.
We have to talk about Alpenglow.
I love that name. Sounds like a ski resort, but it's actually a pretty terrifying upgrade for Ethereum maxes.
It is significant. The Alpenglow proposal, which really gained steam in late 2025, it aims to reduce Solana's finality to approximately 150 milliseconds.
150 milliseconds. That's literally the blink of an eye.
It's faster than human reaction time, and it's about 100 times faster than what they had before.
Why does that much speed matter, though? Is it just for bragging rights?
No, it's about what kind of markets you can capture. Ethereum is capturing the bank vault, market slow, secure, deliberate. Solana is targeting what they call internet capital markets.
High-frequency trading, payments, stablecoin velocity.
That's a really important metric, the velocity. Money just moves faster on Solana. And what's interesting is the team driving this, it's mostly Anza, the team that spun out of Solana Labs. They're challenging the entire Ethereum modular thesis.
They're saying, why fragment liquidity across 100 different layer 2s when you can just make the main chain fast enough for everyone?
It's a compelling argument. If I'm a user, I don't want to deal with bridges. I just want it to work.
So for the listener trying to figure out their strategy for 2026, we have Ethereum as the safe, slow settlement layer. We have L2s making all the profit, and we have Solana just speeding by. How do we invest in this whole paradox?
There's a fascinating concept from Genesis Hukuka called the glass ceiling theory.
Ooh, I like theories. Break it down.
The concept is actually really simple. A layer 2's valuation cannot logically exceed Ethereum's market cap.
Why not? I mean, if Base is making all the money, 98% margins, why can't it be worth more?
Security. Base relies on Ethereum for its security. So if Base became worth, say, $500 billion, but Ethereum was only worth $200 billion, it would become economically rational to just attack the Ethereum network to control or loot the layer 2.
Ah, I get it. The foundation has to be stronger than the house that's built on top of it.
Exactly. So for tokens like Arbitrum or Optimism to really, moon, ETH must grow to raise that glass ceiling for them.
So it's really an alpha versus beta play.
Right. ETH is your beta. It's the index fund. It captures the economic security budget. It's the safer, broader bet on the ecosystem.
And the L2 tokens are the alpha. These are the ones people are looking at to maybe 10x first.
Exactly. They're the tech stocks. Arbitrum is your DeFi and institutional hub. It has a huge TVL, over 12 billion. Base, if it had a token, would be the consumer and social play. zkSync is the privacy and RWA play. They can definitely outperform ETH, but they carry much higher risk.
Speaking of risk, we should probably add a massive warning label on those L2 tokens.
The huge one. They're governance tokens.
Explain that difference. If I buy stock in Apple, I own a piece of the profit. If I buy the Arbitrum token, do I get a piece of that sequencer revenue?
Currently, no. For the most part, no. When you buy ETH, you're buying the commodity needed to run the network. When you buy ARB or OP, you are mostly just buying governance rights. You get to vote on things.
I get to vote on proposals. That doesn't exactly pay my rent.
Exactly. You do not automatically get a share of that revenue.
Yeah.
Now, the DAOs could vote to turn on a fee switch and share revenue.
But they haven't yet, for the most part.
Not generally, no. Plus, a lot of these tokens have these massive unlocks or vesting schedules. Early investors and teams are still getting their tokens, which creates this constant sell pressure.
So Base might be a wildly successful business, but a hypothetical Base token could still be a bad investment if the tokenomics are just bad?
Precisely. You have to distinguish between the success of the network, which is high, and the value of the token, which can be diluted.
It's like the mall is busy, everyone is shopping, but the mall cop's stock options aren't necessarily going up.
That is actually a surprisingly good analogy.
I try. Okay, let's look forward. We're in January 2026. What's on the horizon for Ethereum itself? Is it done upgrading?
Oh, not at all. We just saw the implementation of Fusaka back in December.
Fusaka, another great name. What did that do?
It introduced PureDAS, Pure Data Availability Sampling. Without getting too technical, remember the trailers on the trucks?
The blobs.
Right. PureDAS basically expanded the capacity for blobs even further. It's like they upgraded all the loading docks.
So even bigger trailers, even cheaper data.
Exactly. The goal is to just cement Ethereum as the settlement layer. They're doubling down on this entire strategy. They want to be the TCP/IP of the blockchain world.
TCP/IP, the protocol that runs the internet?
Right. You don't invest in TCP/IP itself. You invest in Google and Amazon and Facebook that run on top of it.
Yeah.
But in crypto, you can own the protocol. You can own ETH.
And that's the paradox. We want ETH to be the exciting tech stock, but it wants to be the boring plumbing.
And that really brings us to the new reality. I think users just need to accept that Ethereum L1 is becoming boring infrastructure. The excitement, the apps, the social stuff, the games, that is all moving to the Layer 2 app stores.
So as we wrap this up, where do we land on the Civil War?
I don't think it's a civil war anymore. I think it's a specialization of labor. Paradox usage up, price stuck. It's a feature, not a bug. The network sacrificed its own revenue to achieve massive scale.
It took the hit to save the user base from leaving.
It did.
So here's the final provocative thought for everyone listening. If Layer 2s are the new app stores making these 98% profit margins, and Ethereum is just the internet connection they run on, is holding ETH in 2026 like owning a utility company, stock safe, boring, necessary, when you could have owned Apple in 2008? Or is it like owning the land that Manhattan is built on?
That is the multi-trillion-dollar question, isn't it? If it's the utility company, well, utilities are stable, but they don't usually 100x. But if it's the land, the rent eventually goes up. And you can't build the skyscraper without owning the land first.
A lot to mull over. Check your portfolios, check your allocation between that L1 safety and that L2 growth. It's going to be a wild year. Thanks for diving deep with us.
Always a pleasure.